Welcome back to Digital Dwell and Deal, where you're going to get strategies, tactics, and insights about how to master the housing market. And today we're specifically going to be going over discount points and why it is that I think that you should actually be considering paying those in today's environment. But before we actually jump into that, I want to make sure that you like and subscribe. This channel is free, never selling you anything, always trying to give you high value, give you a competitive edge of the housing market. But the only way the channel grows is if you like, share, and subscribe. So help me out with that. Like and share, subscribe. Get that going. Let me grow the channel. Let's jump right into it. Now, discount points are a really interesting thing because if you rewind back to the 2004, 5, and 6 days, which most people that you talk to haven't been in the business that long, discount points at that point were nothing more than taking money out of your pocket without really giving you much value in return. So the rhetoric came around about not wanting to pay points or that you shouldn't pay points, and that was really true in that environment. But you know what? That has fast forwarded until today. I'm going to break off a little bit of tangent because that advice really doesn't serve you anymore. It served you back then in those rules. It doesn't serve you today because there's tangible benefit. And it's funny because as human beings, we do this kind of stuff, right? Like, for example, I'm going to break off, like I said, on a tangent. If you end up getting stung by a jellyfish, what should you do in order to get rid of the pain? You know what I'm saying, right? You know what the answer is, right? You should what? You should pee on it, right? Well, you actually shouldn't. It'll make it worse, right? Because pee has acidity to it. It's going to make this burn worse. But why do we all think that we should pee on a jellyfish sting? The reason being is because 20 years ago, there was a Friends episode in which Chandler and Joey were messing around, and one of them got stung by a jellyfish. We were talking about it, and the other one said, hey, you should pee on it. And since then, we have been saying that we should pee on jellyfish stings, and that's simply not true. It wasn't true then, it's not true now. Well, you know what? With discount points, it was true back then. You shouldn't have paid discount points back then because you weren't getting anything in return. However, today, it's a little bit different, right? Because loan originator compensation doesn't change based on if you decide to pay points or not. So when you actually pay those discount points, you're going to get some degree of benefit by lowering your rate as a result of paying those discount points. Now, this is where the finesse comes in. Under normal circumstances, if the market has uncertainty built into it, discount points might not really give you a big reward or big bang for your buck. But in today's environment, when we know that rates are on a downward trajectory, we know that they're going to be coming down, discount points are actually something that is faring really well for people. I'll give you an example. Let's say if you're getting a loan for $700,000, okay, 1 point is going to be 1% of the loan amount. So let's say the loan amount's $700,000 there. It's going to be $7,000. On the surface, you're going to go, oh, I don't want to spend $7,000. That's a lot of money, right? But if that $7,000 saved you $500 per month, in just over a year, you would recoup your investment, and then it would start paying you essentially a dividend. In that case situation, by month 15, you're actually saving, you got all your money back, and then you're saving another $500 per month. This is just a loose example, but what I'm basically pointing to here is when you pay the discount points and it lowers your rate, how much does it lower your payment by, and how long does it take you to recoup that investment? And that's what you really want to be taking a look at there, right? If it's going to take you 8, 9, 10, 12 years to recoup that investment, you probably shouldn't do it, right? Because you may not hold the mortgage for that long. You might sell the house, right? A lot of things can happen. But if you can break even inside of 3 years, dude, that's a money ball play. So how are you going to use technology in order to do this, right? Because you may or may not know how to do that math. Listen, ChatGPT is going to be your friend here. What you're going to do is you're going to ask the loan officer to give you 2 loan estimates or 3, depending on your choice. You're going to take one loan estimate that has 0 points. You're going to take the next loan estimate, ask them for one with 1 point on it. You're going to take the third loan estimate, if you want, with 2 points on it. You're going to dump all 3 of those PDFs into ChatGPT. This is where technology comes into play. And you are just going to ask it, how long does it take you under each model, meaning the one where you pay 1 point and the one where you pay 2 points, to recoup your investment from a perspective of how much you're going to save per month. It'll do the math for you. It'll tell you if it's inside of 36 months, you should do it absolutely no questions asked. Inside of 5 years, you should probably consider it. Anything more than 5 years, you really shouldn't, right? But this is going to help you understand, am I really getting a benefit from paying these discount points? So you're going to use technology, but you're also going to open up a little bit to the fact that you should maybe consider paying points because the environment in which you pay points now is different than when you paid points before. And so when you look at today's environment, so I'll give you an example for today as I'm shooting this video. If somebody wanted to pay, let's say, a point, they would get in some cases, right? Not all, because everything's a little different. But let's say in a case where somebody pays a point and they get their rate down to, let's just say 5.9%, right? So just under 6%. With no points in today's environment, that rate's going to be a little over 7%. That spread is huge for a differential of 1%. A differential of 1 point. Now, why is that? It's because investors don't want the higher rate mortgages. Why is it that they don't want those? Because they're collecting more interest. It's because those loans aren't going to last. They're not going to keep them for 30 years. Nobody is going to go the next 30 years with a 7.5% interest rate on their mortgage when they're going to get an opportunity to refinance down to the fives. They're going to end up pulling that trigger. So the investors actually don't want those higher interest rate loans. So they jack up the rates really high right now if you're not going to pay any points, so they can collect as much interest upfront as possible before you refinance out of it. But if you're willing to pay a discount point, they're willing to pay you a premium, a big one, on the rate right now. And the reason being is because the trade-off for them is if they give you a low enough rate and you're paying an upfront fee for that rate, they're making money right away out the gates, and you are less likely to refinance out of that mortgage anytime soon. So the investors who buy that loan package can rest assured that they're going to collect that interest systematically for the long foreseeable future. So that's why you want to think about paying discount points in today's environment. It's not always a bad idea. It's a bad idea if you don't run the math. But if you run the math and you end up breaking even on your costs inside of 36 months, then you know what? It's actually a very financially savvy play. So open up to that. Look, I'm going to put, if you want to know like how this might pertain to you, or like how rates might affect your situation, or how your situation even prices out, I'm going to put a link in the description to my Calendly link where you can book a call directly with me. We can go over your situation, your circumstances. We don't have to like check credit or anything, but we can just run over, if you know what your credit score is, what rates would look like if you paid no points, paid 1 point, paid 2 points. You would get a good idea as to how that might impact you. And if you're working with another lender right now, it's still a good idea to go through that process with me so you can see the difference in cost savings between what we do on wholesale with mortgages and what you might be experiencing right now. Maybe you're already dealing with somebody that does wholesale, which is awesome. Then you could just have a benchmark to go, okay, yeah, I'm getting a great deal. But oftentimes when I do those calls, what happens is the person books that call with me, and then finds out that, oh my God, I'm getting such a better deal on the mortgage with Amir than I was elsewhere. So I'll put that link in the description. As always, if you have any questions, shoot me a message, and I look forward to catching up with you next week. Don't forget to like, subscribe, and follow. Thanks so much.